Fannie Mae just predicted a scary recession in their housing report, and today we are going to go into it. The headline starts off with housing and interest rates continue to suggest recession likely in 2023. We project 2022 real gross domestic product to be flat at 0.0% growth and to decline 0.5% in 2023, both on a Q4 basis. Now, the 0.0 GDP growth basically suggests that we are in a period of stagflation. Everything really checks out the box. So far, we have definitely had slow periods of GDP growth. We experienced it in Q1 and Q2 of 2022, with the first quarter real GDP declining 1.6%, and also the second quarter GDP going down 0.5%, which these numbers actually met the parameters for a recession. Remember, guys, a popular rule of thumb is that 2 consecutive sets of negative GDP growth typically signals a recession. But we did have a bounce back in Q3, but not really. GDP grew to 2.6%. This will most definitely not become a trend going down into the economy, because that growth came down to a narrowing trade deficit, which actual economists considered to be a one-shot occurrence that won't be repeated in the future quarters because of the higher interest rates that had just hit the US economy. Let's get back to the article. In the near term, we expect modest economic growth over the second half of the year, as large swings in net exports that previously dragged in the first half should boost GDP over the latter part of the year. However, in light of expected continued tightening of monetary policy and global economic weakness, we expect a further slowing in housing activity and sluggish customer spending and business investment growth. We continue to expect a moderate recession to occur in 2023, along with a weakening of the labor market. Now, they mentioned the labor market. Now, I want to go to analytical data about this. As of April 2022, the construction industry alone was short 650,000 jobs, and then 600,000 was lost due to retirement out of that 650,000, also mixed in with career switches as well. The U.S. Bureau of Labor Statistics did a review and found out that 8 million skilled trading jobs were lost during the pandemic, and only 4 million of them returned after the pandemic. And really and truly, this is very alarming because, one, not too many young people are even inclined to even join construction as they once were to, or even do trades as they once were to. So you can see a lot of other places are starting to, well, I've been seeing a lot in the market, a lot of other places are enticing, people to into the labor market more. Now let's proceed on to the article, and I'm gonna add on to more information. Headline inflation has moderated over the past 2 months. However, this is largely due to a significant decline in gasoline prices. Core inflation, along with food prices, continue to remain well above the Federal Reserve's target. Following the completion of our forecast, the August release of the Consumer Price Index showed core prices rising 0.6% over the month and 6.3% on an annual basis, an acceleration of 0.4 from July. Given this, we expect the Federal Reserve to continue its course of raising short-term interest rates and anticipate an additional 75 basis point hike at its September meeting, which already happened, by the way, though markets are particularly pricing in the possibility of a full 100 basis point increase. Our baseline forecast is for the federal funds rate to top out at the 3.7% range in early 2023, but we see upside risk to this terminal rate. Now I got a decent amount to talk about. Literally yesterday, the Fed raised the federal funds rate to 0.75 of a basis point. Now the federal funds rate is 3.25 basis points, the highest level since January of 2008. And even so, the Fed obviously did announce that they are also reducing their balance sheet. They brought a lot of mortgage-backed securities in 2020, which in turn pumped a lot of money into the economy, which probably even accelerated inflation even more. And now they also mentioned gasoline prices. And gasoline prices is very tricky. Well, not really, because the oil companies, they actually have the power to add more oil supply into the market. It's just the fact that they choose not to. And they're making a record-breaking amount of profit from this as well. They are the strongest oligopoly in the world. Now let's proceed on to the article, and I'm gonna add on to more information. We lowered our 2022 forecast for total home sales slightly to 5.71 million units, a 17.2% decrease from 2021, down from our previous forecast of a 16.2% drop. The change was disappointingly due to a lower expectation for new home sales, but existing home sales were downgraded as well, in large part due to mortgage rates again moving higher, exceeding 6.0% for the first time since 2008. According to the most recent Freddie Mac survey, our total home sales outlook for 2023 was revised downward from 5.18 million to 4.98 million units. Now, guys, if you thought 2022 was sluggish for the housing market, well, a good chunk of 2023 gonna be a big calm before the storm, or storm before, I don't know how it goes, you know what I mean. Mortgage rates could reach up to double digits. I'm not saying I don't really know a good estimate, but let's say it probably could reach in Q1 of Q2, Q23, depending on how aggressive the Fed is on their rate hikes. And mind you, this is something we haven't seen since the 1980s. And the Fed has made it clear they are not slowing down until they hit that 2% inflation rate. With rising interest rates like this, you are bound to have a good increase of employment rates, which means businesses are not going to be paid as much, or they're not going to be able to borrow as much money, so a lot of forced layoffs will be occurring. It truly feels as if the Great Resignation is upon us. They also lowered their mortgage originations to 2.17 trillion, which was previously 2.29 trillion. I want to show you guys a graph from Atom. This chart right here shows U.S. residential mortgage originations. Now, the blue means purchase, the green means refinance, and the light blue means HELOCs. So now, as we can see, if we look at Q3 2021, we had a ton of refinances and all the other years before that. And purchases was kind of decently up there, but not as much. But if we look at Q1 of 2022, that's when everything dropped. It dropped dramatically. And this is going to continue to be even worse coming into 2023. Inflation dynamics are shifting. Top-line inflation drivers continue to shift away from rising goods and commodity prices and towards services. While we believe headline inflation has likely peaked, strong rent growth and a tight labor market are leading to a more persistent inflationary trend, which historically has been difficult to contain without a general economic contraction. Oh boy, we made it to the topic of rent prices, and they are still kind of insane, but let's get into it. Now, contrary to popular belief, rent prices have actually went down, but rent still remains above pre-pandemic levels. So not that much good, but it's still kind of better. According to rent.com, rent is up 8.79% year over year. And the average median rent payment is $2,002 a month. But also leading the pack, this is some interesting tidbit information I need to put in here. Florida has a 25% rent increase, which is insanity to me. Okay, now guys, this little tidbit information kind of confirms my point that I said earlier. Upside risk on monetary policy tightening. While payment roll employment growth decelerated in August, it remained at a robust pace of 315,000 over the month. Continued strong employment gains are supportive of consumer spending and near-term economic growth. However, with a growing share of inflation being driven via labor market tightness, continued strength likely increases the chance of greater or long-lasting monetary policy tightening. The Fed has previously mentioned explicitly the need for job openings to decline for wage growth to soften to a level consistent with a 2% inflation target. Now, we're going to look at this graph. Now, as you guys can see, the blue is job openings rate and the orange is employment cost index. Now, with the blue, it's going to have to go down even more, and I'm assuming the employment costs will go down as well because of, the recent quantitative tightening that's going down. I don't think they'll be able to play employees as much as they are going to be able to. Now, let's read downwards from here. From the Fed's theoretical viewpoint, for labor point inflationary pressures to decrease, the employment rate needs to exceed the level of the non-accelerating inflation rate of unemployment, currently estimated by the Congress Budget Office to be 4.5%. The employment rate in August was 3.7%. Chairman Powell alluded to this in August when he stated that some pain would be required to achieve price stability. A further compliant factor is a potential rebound in consumer confidence caused by a pullback in gasoline prices and additional discretionary income. Okay, guys, I learned about this a while ago, and it's discretionary income. And they basically said they're going to have to tighten that. And that's basically saying that they're going to have to take away, the current money that you have right now after taxes. Yes, that is going to shrink down. So the personal savings rate should go down even further.